Pennies Going in Raw is a production of iHeartRadio. The opinions expressed in the following podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide education and entertainment about the financial industry and the stock market. Enjoy!
On this episode of Pennies Going in Raw, we discuss the current state of the market, the second biggest week of the year, and much more.
You find out life's this game of pennies.
Oh, you guys know we only have a 40% runner. Hello, 40% is a fucking killing.
We've been compliant for too long. It's time we go to war.
I don't have a Roth.
Hugh knows so much about the market that his brain doesn't have enough room for grammar.
Hey, who told me about IDEX? It's going up a shit ton now.
We're up 4%, baby. No way. 4 fucking percent.
You asked the exact same question with 2 words different.
It's like, man, I just got dick whipped for like 20%, and now that f***er's up like 50.
I bet Warren Buffett never did that.
I'm just making this voice memo to call out unusual whales to a fight.
The pennies we need are everywhere around us. Pennies.
Going in Raw.
Featuring Dan, Deity Dips,
And Hugh Henny.
Produced by Vinny.
And Christian.
Let's go, baby.
Welcome back to another episode of Pennies Going in Raw. Today is Sunday, June 26th, and we just got done with the second biggest week of the year. Quite a rally. SPY's back at 389 after bottoming in the 360s, up about 10%. Nothing to scoff at. I mean, how often do you see SPY being this volatile, and do you see this as a good or bad thing? I mean, not so much in the overall scheme of things, but for traders.
Yeah, so there's a few things that I want to touch on first. Is that so the market, the S&P 500 was up almost 7% this week. Historically, the market shoots. When you're playing for the market, you're playing for about 8 to 10% a year. So inside, and obviously the market's down. We're inside a bear market, and the market's down 20+%. However, for 1 week to return what the average 52-week return is still pretty incredible. And it'll be really interesting for myself, for all of us, to see if this does in fact, if this volatility does in fact stay. Now, obviously, there's more volume inside the market than ever, more volatility than ever, and the dot-com bubble did have volatility similar to this. However, I'll be interested to see if this lasts for 2 to 3 years. And then after that, what kind of volatility we see. Is this just something that's here to stay for the next few years? Like the market's just going to, with the developments of algorithms and computer generated softwares and, all this stuff that they didn't have inside the 70s and the 60s, is this now here to stay? Like these intraday moves of, 1 to 2% that we've seen over the past, 2 to 3 years. I mean, now we're seeing intraday moves of 3-4%. So I'll be really interested to see, in a decade from now, when we look back at this time period, if it is in fact the same volatility level, or if it kind of goes back to that slow movement, maybe 1% intraday kind of moves. It'll be really interesting to see, and I'm excited for it. So that's just like the first part that I wanted to touch on. And obviously, if anyone has any thoughts or any data, would love to hear it. But to the point about the market is that we're getting to the end of June, and I think a lot of this push up is a lot of window dressing. And so what I mean by that is that the market was down, at let's just say 380. Okay, from 380. If the market were to close, this month at 380, that would be an 8% decline on the month. Because on May 31st, the market was at 413. So if we closed at 380, that would be an 8% decline. in my opinion, I don't think that banks want that big of a decline to show on their statements. Now, if we close somewhere around 402, that only is a 2.6% decline. That's obviously much better. And again, obviously above that 400 level psychological level. So we would have really crawled our way back. And right now, based on like the weekly candle, that's kind of what it looks like, is that we're going to crawl our way back up there. I had originally thought that into the end of this week that they would kind of smoke us a little bit and give us an opportunity to go long. And obviously they front ran it by a few days, and that's fine. I had sold most of my calls on Wednesday and Thursday, thinking that especially on the Biden quote or whatever. Like,
what comment did Biden make that made the market go up? Is I'm fine after falling off my bike or whatever?
No, it was about oil. I can find it, but it was about the demand of oil, and it was just like one of those like the fluff headlines, and the market, pretty much boomed like a good percent just on that. And so I sold my calls because I was really expecting them to kind of through Thursday and Friday to kind of pound the market a little bit, give us a really good opportunity to go long, and then as we close out this month, head back towards that 400 level. But then I reviewed the weekly chart again. And I guess it makes sense. We actually last week. Now I'm talking about last week. I'm talking about the week of the 13th of June 13th. The S&P SPY traded basically 650 million shares. This past week we only traded less than 350 million. So that is a pretty steep decline inside volume over the last week. Now, the one thing that is important to note is that because a lot of people I heard saying that the previous week was capitulation, and that is something where I still don't think that we've seen true panic. We talked about it a million times, and we talked about this that 200-day moving average on the weekly chart. And we said it was around 363, 362. I mean, it came down, literally touched it, and then has bounced off of that. So in my opinion, this isn't really, while we're sitting at 390, this isn't really one of those, capitulation, we go higher to 420. In my opinion, this was a technical bounce off of a level, all at the same time that we're getting close to the end of the month. I do still think that we need to see sub 345, 340.
We're in a tough place when we're getting SPY dead cat bounces, man.
Yeah, exactly. Well, and so that's the other thing, is that back to the capitulation point, is that, now was last week relatively a high week? Yes. When you look at the previous week, it was about 400 million. So, that is true. But if you go back to May, there's 3 weeks in a row where we hit over 590 million in volume. So it's not one of, like, for me to see true capitulation, I think that we need pretty damn close to a halt down day, close to 345, 340. And we need to see like a week where we're well above 1 billion shares trade. Like I want to see like 1.2.
It's crazy that like I agree with you that I think we need a halt down, but I think two things is crazy about that. One, just saying the fact that we need a halt down, like something as drastic as that. And two, there's never really been a halt down off of something like insignificant, like a pandemic, big, like everything shutting down, big. Like the 2008, I don't know, was it made in 08 or was it, that was the first time it was used? No,
that was the first time that it was used.
Yeah, another big event. So it's crazy to think that a Fed meeting, like something Powell could say, could potentially cause something so big to happen. Because market halts are supposed to be like the holy fuck, dude, we got to figure this shit out. And the fact that they're the ones that could cause it is, that's why I think, it happening off a Fed meeting to me just seems, impossible.
That's why me personally, like, I'm always inside the camp of, because here's the thing is that once they, like, that's why, like, 340, 320, I'm probably going to start becoming a buyer, because right around then is when everybody says, that's when when we're at, let's just say we get down to 330. Okay. From highs, that is a drop of just about, sorry, I messed it up.
330. Are you talking about from 480?
Yeah, from 480, that's a 31% drop.
Yeah.
So at that point, that's when everybody's like, all right, the bear market is here, the recession is here, the bubble's popped, we would need to go up, to get back to all-time highs, we would need to go up, a 46%. That's a lot.
That's crazy.
Yeah, so I feel like when everybody kind of admits defeat, if you will, and I feel like that's right around 330, that's when I want to be a buyer. Like, that's when the U.S. says, hey, we're in a recession. That's when unemployment rates start to rise. That's when everybody starts to sell. And that's what I mean is that I want to see one of those days where, like, everybody's and again, this is like I don't wish this upon anybody. However, this is just kind of the way that things work. I don't think 401ks have really been tested, longs have really been tested yet. And that's because we haven't closed below 400 on the monthly chart yet. And again, like, everybody, we're still inside that 400, or, but we have a potential to close above there or relatively close. The next statement that people get and they see the market at 350, that's when it's like, wait, I thought we were just at like 400, 420, so that's when I think personally, that we announce a recession, that we announced that, we're in a recession, people start to freak out a little bit. And again, is that we're like, basically we need a 46%, to go up 46% to reach all time highs. That's personally when I'm a buyer. And again, as we just talked about, where that bounce was off that 200 moving average, on the weekly chart, we're below there, which is, historically over the last 30 years, like a generational buy. Like, it's like a no-brainer buy. So we get below 330, we're a good 10% underneath that. And, coming close to 10% underneath that. And so I'm going to be nibbling there long term. And so I think, like I said, is that I think that we're close-ish. The way that everything's working right now with the market is that it's pricing in so many different moves so fast. Like, all of this is happening at warp speed compared to other bubbles and other recessions. Interest rates, all
the other ones, I don't think, yeah, with bubbles, sure. But this is the first time I feel like where it just went up so fast off of like a sudden collapse, along with so many ongoing real life circumstances,
Yeah. And so that's why, like, I personally feel like, this next move down will be kind of like I still think that, there's a chance that we still see 409, but I really don't think that we break out of this downward trend. And I think that, now again, is that if inflation is lowered and, there's other things that can change the data, because as we always talk about, is that the Fed really controls the market. They take their boot off of the, off of the neck
the metal
of the market.
To the pedal.
Yeah, metal to the pedal. And the market, and all of a sudden, if they become they go from hawkish to bullish, that's when we really see the change. So based on this data now, I still want to see 330, sub 345. But, I still think that if inflation is lowered and we see a pretty good drawdown inside the inflation, the next CPI data, then I can definitely change my stance, and I'd be happy to. However, inside this current market, I feel like they're really just bringing the market up for the short term. Again, bouncing off that 200 moving average, bouncing it back into the end of the year so that when people get their statements, it doesn't look that bad as, 2.5% is way different than 8%. And again, is that, we have another Fed meeting in July. And if you guys notice, we're following the same pattern down, and it's just kind of stair stepping down. So we'll see what happens. I mean, this move kind of looks like what we saw May 23rd, literally a month or 2 months. Yeah, 1 month ago. We kind of hit like that 480 bottom, went all the way back up to 415. And then, the next move down over the next 3 weeks was down to 360. So we're still following this pattern. And bear market rallies are dirty. I mean, there's nothing to it. I mean, just like when we were at 363, and we were oversold to the max. Now we're starting to get to that overbought level. But again, bear market rallies can be really fucking dirty, and they'll rip your face off. So I'm not anticipating anything. Yeah, I have no interest.
When you say like, how can you say, we're oversold, but at the same time we need a halt down? Is it kind of more of like in a short term versus long term, or?
Oh, sorry, I meant overbought, not oversold.
Oh yeah, I meant like when it's
on the short term,
like 363. Yeah, so you're kind of referring to, hey, like we're too high for this week, but like, damn, like this shit's crazy. Another thing, when you're talking about recession, obviously it entails a lot more than just the stock market going down. Is there usually a bear market that's just tags along with the recession the whole time? Or can the stock market kind of be up and down, and the American people, like how it is right now, where we're like, hey, or not right now, but let's say a few months ago, where we were, hey, stock market's doing great, but American people, not so much.
Yeah, so the big shift recently inside the last, I'll say like 20 years, is that the economy and the market aren't as closely tied as they used to be. Meaning that you can be bearish on the economy or bullish and bearish on and be inverse on the market, and that's okay. Which has really been kind of a shift. There's always been a lag between the two, but I mean, realistically, they've kind of deviated from each other, and this is becoming like a bigger trend of even though they lag each other to a degree and they do still follow each other, you can be bullish on one and bearish on the other, and that's okay. And so another thing that, first off, a great follow on Twitter is Macro Alf. I like Macro a lot. And the one thing that he tweeted today, which was really interesting, this is Saturday, is that as per last week, copper is officially in a bear market. And copper bear markets have preceded each and every recession over the last 30 years. Now, even though 30 years is a long time, even though
it's only been like 3 market crashes,
Yeah. So like, even though we're saying 30 years and like, that's this big number, that really is still not that many, it's still not a big sample size. Like anything over 60, 70 years. And I haven't looked at the copper market versus the recession for longer than that. However, I'm assuming that doesn't necessarily follow for like 83 and pre-83. And so that's why, it's just an interesting fact. And this is one of those things where like, I just personally enjoy, kind of hearing, not that I like hearing that, but, it's just one of those stats where like, I like having inside the back of my head, and keeping in mind as like, we kind of think about the current environment of the market. But to your point about the outside factors of the recession is that it'll be really interesting to see kind of what we always talk about is that, how unemployment rates rise, if they rise at all, or if we can kind of bring down inflation without having to kind of smoke the labor market and really, do damage to the personal finances of the average American. Because that's really what's at risk here. I mean, fuck the market. What's really at risk is that, the average American is not only getting hit with, double the gas price from last year, also double, most grocery items are probably sitting at 30, 40, 50% higher than normal. And so, but from all that, besides that, the next thing that kind of typically comes down the barrel is a raise in unemployment. And then that's when, you start to see the real toll on the average American. And, right now, you can kind of live paycheck to paycheck and cut things out. But if unemployment rates rise, that's where you really see, the average American struggle. Because now it's like, not only can I not buy, maybe gifts for Sally for her birthday, but now I can't buy food. And that's where, if unemployment rates rise, I'm only talking 2%, it really stirs up the economy and especially the average Joe. So I'm really hoping.
You kind of go back to that scene in The Big Short, whenever they finally get their AAA bonds, the JP Morgan Chase kids, and then they're cheering about being right because the market's going to crash. He's like, hey, dude, for every 1%, unemployment rises, the suicide rate goes up by 40,000. That was in 2008. I don't know what, mental health is like comparatively, but the real life effects are definitely there. Not just 401ks and your TDA account getting wrecked.
Exactly. And the one thing that I will say is that because it sucks, especially like us being traders. Like I know, like me personally, like I enjoy the short side more than the long side, and that kind of sucks because it's kind of like I'm betting against. I'm kind of betting against the average Joe. Even my parents, like my mother and father listening right now. Like I'm betting against them. That blows. And it's not always fun to think about. However, the one thing that I hope that everybody, and everybody kind of takes away from stuff like this is that the market's never not gone higher. So we should always look at these lower prices as opportunities.
You sparked something in me right now. Okay, you ready?
Oh, I like it. Is this inspirational, Dan?
No, it may be better. Okay, so 401ks got me thinking. Retirement funds, etc. Fuck it, talk about your Roth. If 90% of all stocks go to zero, why not just short every stock in your retirement fund long term? Boom.
Well, because all it really takes is the one Amazon or the one Microsoft.
Well, I mean, hey, look, if one's really picking up, you're like, okay, dude, we'll cut our losses on this one. eBay, this whole eBay thing's working out. We'll cut it.
No, but I mean that there is something to that because obviously a lot of people deploy a strategy of shorting and especially 3+ years ago. I mean, I'm talking specifically short small caps. Oh my God, if something was up more than 40%, I mean, you could just short the hell out of it and just add more. Like as long as you had capital, you knew that within the next 3 days, that thing would be in the gutter.
Yeah, I'm sure they thought that about AMC and GameStop too.
That's what I mean. The past 3 years, oh my! I mean, there was a few in 2020. I mean, I alone had 5 1,000% swings in first 7 months.
Yeah,
so
no,
I can't even imagine
off the top of your head, like Waiter, IBIO, Zila, the fucking whatever the cartoon channel was. Everything, and it was like the larger caps too, like PIN going from 4 to 80 and shit like that.
But yeah, so that's what I mean is that that is definitely a strategy. But further so, I do think that it probably does get a lot tougher on the average American over the next 16 months. But it's one of those things where like we got to kind of pay for our, I don't want to call it our mistakes, but somebody's got to pay for it, and it always falls on the shoulders of the average American. Always, it always will.
The old saying, no such thing as a free lunch or no such thing as a free $1,200 stimulus check. Yeah. And so I think that however, is that as we just talked about, is that, everything's kind of happening at warp speed right now. I mean, we're going through the cycles like nobody's business. So, hopefully this is something where
it's kind of more short term, because as we talked about is that even though we talk about like 2008 and we name it 2008, it was really 2007 to 2009. Like we talk about the dot-com bubbles were like 4 years. So we're really only like 6 months into this.
Like when you talk about like bubble, are you talking about like it's the explosion part? Because I mean, you think about it, like I'm only so versed in this because I might have watched The Big Short for like the 17th time this week. But you think about like he realizes it's gonna crash, and he realizes that in 2006. What his issue was he was a little too early. When you're talking about bubbles, how exactly do you know? Are you talking about just the popping of the bubble's whole existence and the popping, or because how would you even know where it started? Like if you're gonna say the housing bubble, I mean, shit, you could say it probably started in 1990, not exactly 2005. It was just building up and building up and building up.
Yeah, the way that I think about it is typically from peak to bottom, and then like kind of like a curling back up kind of thing.
So if you said if like all crypto went to zero over the next 6 months, you would say from the peak of it. So you're saying from 65K to zero of all the crypto would be
65K to zero to like fit 10 or something, something like that, to where like, if you didn't nail absolute bottom, you could still make money kind of.
Yeah.
Okay. Because that's the way that like I look at most of these things. Like 2008, again, I talk about this 200 moving average on the weekly chart, till I'm blue in the face. And again, is that if you bought under there over the last, few bear markets, then, you have generational. However, if we look at like 08, if we look at 08 in the 200, I mean, it dipped below there in June. Okay. In June of 08. And it didn't get above and stay above until 2010. So
you're saying 2 years below the 200 EMA, which is what you say is like the golden rule almost of SPY.
Yeah,
so, I mean,
typically if you buy below, you can get 100% return.
But you could get a 2 year scare though.
Exactly. That's the thing so that's why like I'm saying like, hey, let's not rush this because technically the 200 in that July date that I was talking about was at 130 and it went all the way down to 67. And if you guys really want to see capitulation, this is a really good look at it on if you go back to 2008. I mean, it's really high volume selling and then even higher volume buying the very next week. And we saw a bounce from 67 all the way back to 76, which again, that doesn't seem like a lot because we're trading inside the 400s, but that's a 9% bounce. So that to me is capitulation. So this week, another thing that kind of goes into my thesis of why we see lower is because the buying wasn't out the wazoo. Again, if we saw some crazy volatility on it,
so you're looking for the volume, not the move. I
want to see real buyers. And so another thing that while I'm just doing this, I find really interesting is that these days. In 2008, 2009, when we had bottomed there, I mean, we had traded that week, we had traded 2.3 billion shares. And then next week, we traded 1.9 billion. So when I go back to our and obviously notional, it's different. But when I go back to our chart and I see only a tenth of that kind of scares me. Now, again, notionally, it's different because we're talking about the difference between 67 and 400 or 380, whatever. But just from a volume perspective, I don't, it's not like crazy. When you look at the volume around that time period, the volume is off the chart, relatively speaking. You look at ours, and it just looks like regular, normal volume. So that kind of also goes into my thesis. But yes, I do think that 200 does become a spot. And even looking at 2008, it dipped below it, and then next week was above it. Stayed above there for 3 weeks, and then dipped below. And then the next week was back above for another 5 weeks. And then it came below, It came below and didn't the next week didn't get above there, and then for the next few weeks kind of stumbled around there, and then it came back up, tested the 200, and then that's when we saw the move from 130 down to 74, which is that's like a 40% drawdown in how many months was this? This was in 3 months. So a 50% drawdown in 3 months after getting below the 200. So could you imagine if we get below the 200 and then in 3 months, so let's just say July 30th, we got below the 200. And let's just say that over the next 3 months, we went from 360 to
180
all the way down to 180. I mean, that would be crazy. But, that's kind of what we saw. So, but again, is that, we did have a 50% drawdown from being below the 200. So I don't want to rush any buying. And that's what I mean is that even though if you buy below the 200, you're guaranteed a good return at some point, historically speaking, but that being said is that there's still clearly a lot of room to go below there.
Yeah. I mean, there's also the world has always made it out of every world war. So, I mean, I guess if there's a third one, we should be fine on that front too, huh?
Yeah.
I don't know if that's true. They may have atomic bombs, dude. It may just be fucked next time.
That would suck.
There's it may be historically always true, but dude, spooky. Hate the stocks. So if anyone's been wondering about this catapult word Hugh's been using this whole time, it's funny when you Google capitulation. I feel like there may be one word in the English dictionary that Hugh knows better than me. It says all these agreement in times of war for the surrender to a hostile armed force, but then it's all stock charts. So basically when he's saying capitulation, he's talking about basically panic selling because they don't want to fucking lose any more money, obviously.
Yeah. The easiest way that I kind of think about it is that, I didn't really watch many cartoons, but, if you're thinking about a cartoon where there's 100 mice running from 2 cats, and the 100 mice are all trying to fit through one tiny door, and they all can't fit through there. That's kind of what I need to see. I need to see where there are bids on the tape, but there's just the sellers are just smoking the bids. That's what I want to see. I want to see a billion volume week. That's what I want to see. And then the next week, I want to see something similar to what we saw this week. A nice green week, but again, the volume needs to be there. The volume can't be half of the selling. It has to be. In fact, I'd like to see it higher. Because that's what, again, all the market comes down to is supply and demand.
All right. Well, I know you just mentioned a bunch of mice going out of the same door. Slightly off topic. You want a fun fact?
Yeah, I do.
Okay.
I love fun facts.
All right. So, did you know all fire exits? They're all push. They're not pull, right? I don't know if you know that, but that's true. Do you want to know why? You want to know why that's the case?
Why?
One time there was a fire. I don't know the year. I want to say it was at a theater or something, and everyone's rushing to the door to get out. But it's a pull door and everyone's packed behind them. So they couldn't pull it and then they all just fucking burned to death because they're all just trying to pull. So then after that, they made them all push.
That's insane.
Yeah. Hey,
I didn't know that.
Hey, yeah. So now I definitely don't pull on the door if there's ever a fire because it won't go that way. So one more thing we want to talk about before we go. So I know back in May, we talked about all of the meme stock gains are gone. Well, you found some news out that apparently all the 2020 gains are gone.
Yeah, so I'm just gonna read a little thing from Bloomberg here. And so it says that as the first half of 2022 shapes up to be one of the worst on record for financial markets, retail investors have been boosting their bets on a further downturn in U.S. equities. Which again, if you never trade a bear market like myself, go back and look at the data because bear markets can rip your face off. That's why I still think there's a chance that we see 409. before we potentially see a move down, because everybody gets super bearish, and then they get super bearish, and then all of a sudden the market bounces 15%, and then you get smoked, and then the actual move down happens, like that. So that's one of the reasons, like, you'll never, like, I am not although I'm biased, I have no money. I will not be anticipating anything, but last week's net relative bets against stocks exceeded previous records set in the early days of global financial crisis in 2008 and the start of the COVID-19 pandemic. He wrote in a research report, the firm estimates day traders playing the options market could be sitting on a $600 million or more in losses since Thanksgiving.
You think that's all Manziel's followers? I'm just playing. Love you guys.
So it's just, that's a lot for the retail market.
Yeah. I think it's funny. I think in 2020, it's like the hedge funds were quote unquote too smart to make a fuck ton of money, because they were just like, oh, everything's gonna crash. Everything, it's gotta crash. And the new day traders were too stupid and ended up making a fuck ton of money, but they're too stupid to keep it. Now the hedge funds are finally making, the money that they thought they should have. But I think they thought they were too smart in 2020 to think that, like, oh, here comes all these dumbass traders that are about to fuck shit up. But they're about, it looks like they're about to leave if this keeps up. So we do want you all to stay and trade another day. Put that on a t-shirt.
Yeah, that was good.
Okay. All right, guys. Well, we'll see you next time. Vinny put at the beginning of this, take a shot every time you hear Hugh say capitulate. And y'all have a great day. Peace.
Pennies Going in Raw is a production of iHeartRadio. For more podcasts from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts.